only on Bloomberg Quint.
Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines this Monday afternoon. Indian markets trade completely flat. Oil marketing companies are the top losers as crude prices head higher.
Titan posts its highest ever intraday gain after the jewelry maker and watchmaker posts a 68% jump in its bottom line.
The lenders to Reliance Communications are not thrilled with the new restructuring plan provided by the company. They are seeking adjustments to that plan.
Reliance Nippon becomes the first asset management company in the country to list on the bourses, listed a 17% premium to the issue price.
And Saudi Arabia blames Iran for an attempted missile attack on the Riyadh International Airport, says it could be considered as an act of war.
Also on the show, interesting conversation that we've lined up. How will the tensions between Saudi Arabia and Iran affect oil prices? David Lennox of Fat Profits. We also take stock of the economy post demonetization 1 year down with Sajid Shah of JP Morgan. We discuss global markets with Joe Rundle of Think Markets. All that coming up a little later on the show.
All right, but let's start with the markets. How things shaping up at the start of the week? About a 0.3% gain on the Sensex. Nifty about 0.25% higher. Neeraj, what's moving the markets today?
Oil is on the boil, and that's resulting in some of those commodity names reacting duly. But yeah, I mean, rate sensitives too not doing too badly either. So I mean, just have a look at what one index has done. I think it's doing reasonably okay. The number of stocks sitting pretty at new highs is not less impressive either. I think about 182 stocks have hit fresh highs on the BSE in today's session. So on a flat day of trade too, we've not had a bad outing for the broader end of the spectrum. But speaking of what's moving the index, ONGC, a big leg up. Vice versa, of course, OMCs have come off a bit, but ONGC a big leg up really. 198 for that stock, nearing 200. This would be 6 month, 9 month or thereabouts in terms of highs for this one, so doing okay. And I think autos have added a lot of long positions in the session today. I was just looking at the open interest that is there in Tata Motors or a Maruti, etc. I think all of these names have added good open interest and good price action in all of these three names and some others as well. So fresh long positions certainly being seen in some of the auto names. Let's, then the other broader end of the spectrum moves. I think enough and more stocks, largish names, liquid names gaining 3, 4, 5%. You will always have small caps gaining 20, 15 odd %. But quite a number of large names, mid-sized large names are gaining some traction. So it's been good going by and large. Sure. Oil remains a concern, but that would probably be a concern for the broader economy by and large as well. But certainly that is moving the markets.
Okay, hold that thought, Neeraj. We're on the last leg of earnings season, and 3/4 of the Nifty has already reported numbers. 8 of those 35 companies have beat street expectations in the quarter gone by. And the reason is cost control. Neeraj has in fact done a deep dive on this of the income and expenses of companies in the second quarter. And what does it really show? It shows it's about managing costs. Neeraj, over to you.
Yeah, so there's some interesting data out here. About 78.8% as of Friday have declared the numbers. And out of this list, if you move on to the next slide, let's just move on to the next plates quickly. The Nifty weightage ex BFSI, and I mean, Ira will come in, I'm sure, on a lot of what the BFSI names have done. Banking by and large has done okay, but ex BFSI, about 41.1%. Out of this number, 28%. So 28% of the overall weightage, but I'm saying ex BFSI, 28.1% have displayed better operational performance. Now the key statistic is not a single company, guys, not a single company which has not displayed cost control has managed to beat estimates. That's telling. Typically, you would probably see in a quarter or two, maybe higher revenue growth, even if there's no cost control, better than expectation number comes out, but that's not been the case. Now, look at what's been at the forefront. I think the tech companies, except for HCL Tech, the other top 4 have done remarkably well on on the EBIT margin front, compared to what the estimates were from this column, the actual numbers for all the tech companies have been very good. Now, we can always argue, yes, that this would be because of employees getting fired or otherwise, and therefore whether in the larger good or no. But from a company's perspective, tech companies have done well. Interestingly, it's been a mixed bag for commodities by and large. So input cost pressures, final output prices doing okay, but operationally very weak quarters for IOC, ONGC, Vedanta, Tata Steel. And well, flip side, Hindalco has not done too badly. Cement companies, Ultratech and Ambuja have not done too badly. So for the commodity-based companies, pretty chalk and cheese. And then banks, I just took cost to income as one statistic of whether trying to see whether these banks have done well on the cost to income ratio or no. And save for Axis, which is, in a manner of speaking, a slightly patchy time, the others haven't had a bad cost to income ratio as well. Now, I just want to bring up two qualitative points out here. Let's move on to the next slide and you will see what I'm trying to talk about. Look at what's happened to these 2 or 3 names that I've chosen, aided by cost control. I've just taken these as examples. TCS, the income, 3.2%, but the margin improving from 23.5 to 25, and therefore the net profit moving up by 8% compared to total income growth of 3%. Similarly for UPL as well as Z. UPL, revenue growth of just 6.5, but margins improving, bottom line growth of 43.5. There were some other anomalies as well out here. Z, there was an exceptional gain, yes, but even if you strip the exceptional gain, despite a revenue loss of 6.5%, the 600 bip jumps in margins really aided the company and gave it some legs to post some bottom line growth. So, and there are some various other numbers. I mean, IOC, there was weak cost control, the numbers look shabby. Similarly, for a couple of others, the cost control measures were just not in place. All in all, a large portion of Nifty 50, and I'm sure the broader in the spectrum as well, but I've just chosen Nifty 50 as my sphere. They have tried to or displayed cost control, and that has aided the numbers, if at all. It's been a rather good quarter compared to Q1, and cost control has played a large part here, guys.
All right, Neeraj, interesting stuff there. Essentially, the message being that this is still a time in which companies feel they need to tighten their belts if they want to continue to display the kind of earnings growth that markets are expecting. Moving on to one particular company, it's been fast-paced developments for Reliance Communications. Remember that they have not been able to close the deal with Aircel. They also have not been able to close the deal with Brookfield, as reported by the Economic Times. On Friday, Bloomberg Quint's Vishwanath Nair reported that lenders are not particularly happy with the new restructuring plan that Reliance Communications has come up with either. This morning, the stock is trading lower because there is a bond coupon payment deadline today. Plus, there's uncertainty on how the negotiations between the lenders and the company is going to go from here. Vishwanath is joining us. Vishwanath, first I need to understand exactly what is the problem that the lenders are now raising. It has to be said that the lenders sort of, took this upon themselves when they said that they're going to invoke SDR in a company like this, where there's so many uncertainties, and now they're saying they're unhappy. But what does that mean?
So how we understand it, Ira, is that in June, when they first approved the SDR, it was said that the wireless business would then get merged with Aircel, while the tower business will get sold to Brookfield, and then in the remainder of the company, they would convert the debt into equity, take control, and therefore then do the SDR process as they usually do in other companies. But after these two deals have fallen through, they aren't clear what portion of the company they get to convert the debt into equity. So now, as the plan that the company has submitted, it says that 7,000 crore worth of debt out of the total 45,000 crore would get converted into equity, which would represent a majority stake in the company, which at least 51%. What the bankers seem to be saying, they seem to be suggesting is that 7,000 crore is probably valuing the company way too high, and probably only a much lower portion of the debt can be converted so that the company can be taken over by the banks. So they've asked the company to go ahead and come back with a reworked plan later part of this month. This plan is likely to show a lower portion of the debt getting converted. Now, if you remember, on the 30th of October, when the company submitted its first plan to the investors and to the media, it said that the lenders will not take any kind of haircut. So, it needs to be seen what the new restructuring plan is going to look like and whether there is going to be a haircut for the lenders at all.
Okay, Vishwanath, two quick follow-up questions. One, as things stand right now, the SDR will still be invoked. I'm not clear about that. And point number two, if it was not to be invoked, then will banks have to mark this down as an NPA in this quarter or post the December quarter?
No, so the SDR continues as is. So the standstill on the account, which is there till December 2018, will remain. And by December, if there is no resolution plan that is submitted, then by December, under the SDR norms, the banks had 6 months to convert debt into equity. So that will go as planned. So the resolution plan that the company is submitting is trying to see and to find out a new way to sort of restructure this 45,000 crore debt in a way wherein the company will remain in the hands of the current promoters, or at least the restructuring will go as planned by the current promoters.
All right, Vishwanath, we'll leave it there. Thank you so much, indeed, for joining us. Vishwanath and I talking about Reliance Communications. Let's move on now and talk about the other group company. Well, Reliance Nippon Asset Management that listed at the bourses today, it listed at a premium of nearly 17% to its price. Yatin caught up with Sandeep Sikka of the company, Executive Director and CEO of Reliance Nippon. Although the AMC plans to tap the international markets, he says the focus will remain on India.
I think we clearly see ourselves playing a bigger role, getting a bigger share of the money coming into India. So as Toda-san already mentioned, we have $1 billion fund in Japan. We are giving an opportunity to Japanese retail investors to participate in the India growth story. Going forward, the Thailand fund we touched about. Also, we are trying to do a few things in US and Europe. So clearly, we see ourselves being a India-focused asset management company, whether raising money in India and investing in India, or giving an access to foreign investors to be given to the Indian markets. So we will clearly we will try to leverage the relationships of Nippon Life across the world, which we have successfully started in Japan, Thailand, and some other parts of the world, and that will keep increasing going forward.
Okay. And Sandeep, one final question. Since you are not a banking institution, unlike your peers like HDFC Mutual Fund or ICICI Mutual Fund, which have a bank parentage, so in terms of distribution and in terms of reach, how do you plan to ramp up your operations? Is there any specific tie-ups that you have planned moving forward? You are already present in some banking channels, but independently in terms of branch operations or in terms of reach, how do you ramp up the overall distribution reach and penetration?
No, I think the way we see, yes, you're right. I think of the top 3 asset management companies, we are the only one which is not sponsored by a bank. We don't see that as any disadvantage, rather we see as an advantage. Today we have all the banks in India, the banks that you talked about, and other private sector banks, public sector banks, they sell our products. We also have 58,000 IFAs across the country who are selling our product. So we have a right mix. The way we have done it from a distribution point of view, no distributor is for more than 4% of our assets. I think we'll keep expanding both in the physical branch network as well as in digital. At this point of time, 20% of our incremental new transactions are coming through digital. And one of the object clause of the issue of the money that is coming to the company is 2 things. A is opening further branches, which from 171 will go to 500. And also investing a lot on more in digital, which we believe is going to be very important in times to come.
All right, that's the management's perspective, but let's get our own analysis into Reliance Nippon. Somit is standing by with, of course, the listing details and also a bit of insight into the company. Somit.
So Reliance Nippon is the 3rd largest asset management company in India after ICICI Pru and HDFC AMC. Now the market share of Reliance Nippon is close to 11.4% and the asset under management is more than 3,84,000 crore as of August 2017. Now if you see the financials of the company, its revenue and net profit grew at a compounded annual growth rate of 21% and 15% over FY13 to FY17, which is at a slower rate when compared to ICICI Pru and SBI funds. But when compared to HDFC AMC, it is at par. But if you see the return ratios of the company, it is the lowest among its top players. Now the return on equity of Reliance Nippon is around 22%, while return on capital employed is around 25%. Now comparing this with ICICI Pru's return on equity is 3 times that of Reliance Nippon, and the return on capital employed is almost 4 times more than Reliance Nippon's capital employed. Now if you see the valuations of the company, now the company got listed at a price of 296. The market cap of the company was close to around 18,000 crore, while price to earnings was around 45 times, and market capitalization as a percentage of asset under management. Now this is the key metrics to value asset management company, that stood at around 4.7%. Now is this valuation expensive? No, it is not, because if you compare it with the valuations at what the promoter Nippon Life bought stake, it is still cheap. Now Nippon Life bought stake in 3 different stages in Reliance Nippon, in 2012, 2014 and in 2015, and the valuations at that time were around 6.6%, 5.6% and 5.6%.
Okay, Somit, we'll leave it there. That's Reliance Nippon for you. That stock is listed at a premium of nearly 17% to its issue price. That's the stock for you, trading nearly 15% up at this point in time. Another stock that posted its highest intraday gain today is Titan. This is after the company posted a good set of numbers in the second quarter, which prompted brokerage houses to hike their target price on the stock. Agam is standing by to tell us what's going on with Titan and what's led to this spike in numbers. Agam.
Well, clearly, Harsha, it is the earnings because not only have we seen the top line, which has been growing by as much as 30%, but that's been driven by 37% growth in the jewelry sales, and because of which we've seen an expansion in margins up as much as 11.5% as against 9.9%. Now, in terms of brokerages, again, all of them have given thumbs up to the earnings. We were already expecting a good quarter, but this has surpassed expectations. So starting off at Credit Suisse and Titan, they maintain an outperform. The price target has been high to 760 from 635, and the management ascribes to a better mix as well as cost control going forward. And when it comes to Macquarie on Titan, they also maintain their outperform with the price target high to 907 from 700, and they say that the expansion and margins that we have seen is largely structural, so they are also constructive as far as Titan is concerned.
All right, Agam, thanks so much for that. Nishant Sharma in Bangalore caught up with the Titan's chief financial officer to try and understand what contributed to the robust quarter. Let's hear out a slice of that conversation.
Gold and harvest is continuing to do well. It's keeping very well. It's still contributing about 17 to 18% of our revenues. And this is expected to grow over a period of time. Premium segment has been growing quite well. Many watches that we have launched at the high price segments are doing very well. In fact, the growth is highest for us at the higher price points. Right. So I think the premiumization strategy is working. You can't expect a 36% sort of growth every quarter. Right. Your base also changes. So next quarter, for example, we had a fantastic October last year. So to that extent, the growth that we are seeing now will be a little muted because the base is going to be also impacting overall growth. But having said that, we've seen good traction. So hopefully we'll come up with decent numbers.
That's the management of Titan. The numbers look good. The street likes it. The stock is up nearly 16% or over 16% in trade today. Torrent Pharma has agreed to buy the domestic business of Unichem, one of India's oldest drug makers. Both the counters have gained in trade today post that announcement. Darshan is standing by to give us the contours of this deal and what this means for both Torrent and for Unichem. Darshan, was this on expected lines?
See, it came in slightly higher than what the street was anticipating. So 3,600 crores. The general, media report that had come out was anywhere between 3,200 to 3,500 crores. So this pretty much come at the higher end. Now, this values the company at the domestic business at almost 12 times EV to EBITDA. So for Torrent, it's a good deal because Torrent itself is trading at 14 times. So for Torrent, it's a good deal. What does this deal mean? First of all, there's not enough overlap on both the counters. So that way, it's a good deal. Apart from it, there is significant amount of cross-selling that can happen. The field force productivity can improve significantly for them. So that are some of the positives, and Torrent certainly has the balance sheet strength to pull off such an acquisition. So individually, let's talk about it. What do Unichem shareholders gain? Basically, the management is indicating that whatever is retained, 50%, more than 50% of that will be given back to shareholders by what way they haven't decided. It could be a dividend, buyback, or some other method. So if you're expecting that, a shareholder will get that. But now you're only playing in for the non-lucrative US international business for the company. For a Torrent shareholder, yes, there is significant amount of significant amount of synergies that will come in as far as some of the therapies are concerned. Apart from it, the market share gain is significant. They will move up significantly in the rankings as far as IPM is concerned. So for both the counters, it's a good deal. For Torrent much more because it will be EPS accretive. The management is saying that they will be able to turn around, and the management has time and again proved that they are capable of turning around companies. But let's listen into what the Unichem management had to tell me when I interviewed them post the deal.
Once there is a slump sale, you have to pay the tax, then the company has the proceeds. Okay. Those proceeds get divided, in my case, only into two things. One, developing the second business, which I think has great opportunity.
Okay.
And whatever is not required will be returned to the shareholders.
So what's the, so how much you're getting 3,600 crores? I'm sure you have the calculations at the back of your mind, because without that you wouldn't get into this deal. So there'll be a tax, let's say 20% or whatever.
I can just cut you short by saying more than 50% of what we are able to retain will be given back to the shareholders.
Is there a potential that you would look to sell your international business also at a later?
See, today if I wanted to sell, I should have sold the whole thing, right?
Yes.
I feel there is still a lot of value to be unlocked in my international business. That's why I'm prepared to take the sort of situation wherein I have confidence that I can build that up. That's why I'm not talking of doing anything right now. Let me build some value, then we'll see.
You're confident that it will be closed by the end of the year?
That's the intention on both sides. But you know, there's always an issue in terms of anything can happen. The good part about this deal is there are no regulatory approvals involved.
Right. With metal prices rising, steel companies were expected to post a healthy set of numbers for the September quarter. However, rising input costs seem to have dented margins. We caught up with Sheshagri Rao, Joint MD and Group CFO of JSW Steel, to understand if costs will continue to weigh down steel makers, and he believes things are likely to improve in the second half of the year. Listen in.
In the first 9 months of the year, or for the entire calendar year 2017, the steel demand is expected to be higher by 7% and in China by 12.4%. So that is a very positive sentiment as regards to global steel industry outlook. That's why we are seeing some stabilization in the prices and also an upward bias in the overall steel prices. And the investment sentiment is improving. Infrastructure investment globally is coming up again because of the higher commodity prices. But going forward, the way I am looking at is, I am not seeing a further increase in the input prices, number one. Number two is steel prices and margins are stable. Because demand is robust, I expect the margins also to improve in the second half over first half.
Sheshagri Rao of JSW. Meanwhile, the Supreme Court has rejected a plea filed by Jayaprakash Associates, the debt trap company which has been asked to deposit 2,000 crore in an escrow account by 13th of November. It had in fact sought more time from the Apex Court. Arpan Chaturvedi, who's been tracking this case very closely, joins us on the phone line. Arpan, so what's at stake for JP Associates? Are they willing to deposit that money right now?
That's right, Harsha. So what has basically happened in this case till now, that JP Associates was asked to deposit 2,000 crores by the 5th of November. And that deadline has expired. After that, today JP's counsel came to the Supreme Court and they said that they are not able to deposit that amount, and that is why they asked the court to modify the order. And they said that they can deposit an amount of 400 crores. That's all that they can deposit managed for now. The Apex Court has refused to modify anything from that order. So what now that means is that they will still have to deposit 2,000 crores. And after that, the court has fixed the date of hearing on 13th of November. And the small respite that JP Associates have got is that they will have to deposit 2,000 crore, but the court has said that till the date of next hearing, they have to deposit a sizable amount, which is something around 1,000 crores. So no change in the order, but yes, partial relief that till the next date of hearing, they will not have to deposit the whole 2,000 crores, but a sizable amount. That's all that has happened in this case, and the next date of hearing is November 13th.
Arpan, thanks so much for that. The stock trading low, about 1.5% down on JP Associates. Let's moving on to international news. Actually, a couple of bits of news coming in from overseas. Saudi Arabia blamed Iran for an attempted missile attack on Riyadh's international airport. A statement carried by the state-run press agency calls it a direct military aggression that could be considered an act of war. A spokesperson for the Saudi-led coalition in Yemen earlier accused Iran of providing Yemen's Houthi militia with ballistic missiles, launchers, explosive-laden drones and sea mines. The Houthi rebels have claimed responsibility for the missile intercepted by Saudi Arabia through their air defense systems.
But there's more action from that part of the world. At least 17 high-profile Saudi Arabians, including senior princes, current and former government ministers and businessmen, were arrested by security forces this weekend on the orders of King Salman. The purge is being billed as a crackdown on corruption, but also concentrates power around King Salman's son, Crown Prince Mohammed bin Salman. Bloomberg Yusuf Gamaluddin now joins us from our studios in Riyadh to tell us about what really is going on. What's going on, Yusuf?
Yeah, so as you pointed out then, a sweeping process that really included some of the most high-profile figures in this country across business and politics, princes, current and former officials, unprecedented in the history of Saudi Arabia. And the question that this raises really is whether the reform process more broadly is moving too fast. The Crown Prince Mohammed bin Salman, he's been at the forefront of this. He cemented his position already over the summer. And now with this latest move against some of these figures on the basis of corruption, it really could feed into more concerns that a country that historically has not been very flexible in terms of opening up to new reforms and to new ideas is suddenly moving at too fast a clip. And you certainly get that sense being here on the ground in Riyadh and speaking to a lot of the stakeholders.
What's the message? You know, you mentioned that the Crown Prince is in fact leading this purge. What's the message that's being sent out by these moves, Yusuf?
I'm going to quote straight from the message of the King over the weekend in terms of the message that is being sent. The comments were quite clear, pointing out that they will not let anybody be above the law. They will fear no one, quote, and that is the same whether big or small. And that is the message that's being sent. Corruption will not be tolerated. Arguably, there is a part of this population that is going to welcome that. There is a percentage of investors that are going to welcome that in terms of transparency for some of the listed companies. But it also sends a signal of fear a little bit in terms of where the story evolves from here. These high-profile people, what's going to happen to them? What's going to happen to their assets? Al-Walid bin Talal, the most prominent of those arrested, has a major portfolio domestically. Kingdom Holding and Kingdom Tower right behind me, you can see it, is a key feature of the Riyadh skyline. You're looking at a portfolio of assets abroad ranging from a stake in Accor to Citigroup to Twitter. What's going to be the resolution of this standoff with these influential names?
How are market participants reacting right now? Is this a state of panic, shock? Can you explain to us what people are telling you on the ground?
So the message from investors and what the smart money is pointing to is that this is a centralization of power that is necessary to do the kind of painful reforms that are needed to push this country to the post-oil age. That's the consensus message from investors. There's no two doubts about it. And you're seeing that as well in the reaction on the equity market. A little bit to the downside yesterday, a little bit to the downside today, with Kingdom Holding being the exception for a number of reasons. And the same applies to the forwards markets in terms of the trade against the Saudi Riyal peg. So the 12-month forwards there saw a little bit of a spike, but nothing compared to what we saw over the summer with the Gulf crisis and the tensions with Qatar, where we saw a major spike as well in the 5-year credit default swap. So the reactions in terms of money, in terms of capital, have been contained. But having said that, there's still a lot of unanswered questions about the resolution of this story that could still change these capital flows quite significantly, and also has a lot of decision makers on edge. They want to see how this plays out first.
Yusuf Gamaluddin, we'll leave it there. Many thanks indeed for joining us. Yusuf Gamaluddin reporting from Riyadh about the latest situation in United Arab Emirates, the Saudi Arabia particularly. But it's interesting to find out what this means, Ira, because this has gotten investors globally a bit nervous. Oil, for instance, has surged for the third straight session, where I'm talking both WTI and Brent prices, and that's perhaps the single important factor that can topple this party that's going on in global markets.
Absolutely. And I think David Lennox is joining us on the phone line to help us understand how deeply all of these developments could impact the oil market. He is joining us on the phone line. He's a senior resource analyst at Fat Profits. David, good afternoon. Thanks so much for taking our call. I guess the first question is fairly basic as to what you have made from an oil market perspective of the sort of two disconnected developments that have been going on. One, the tensions with Iran, and then the Saudi purge, as it's being called. How are you reading into that, keeping in mind the oil markets?
Certainly, if you have a look at the Saudi-Iran tensions, that's been going on for some time now. Both of those countries have been on opposite sides of a number of conflicts in and around the Middle East. However, the rhetoric has seemed to have stepped up a little bit, and we do think that with events that we're seeing happening first in Lebanon, and of course the purge that we're seeing in Saudi Arabia itself, and what that may bring in terms of new focuses on various aspects of the geopolitical, we think that the markets are now watching very closely, and we've seen some reaction in the oil prices over the last couple of days in terms of price increases. We think the markets are going to watch very closely now what's going to happen, especially in Saudi Arabia, to see if the new regime will bring with it a change in attitudes around the Middle East.
David, last week we were talking about oil prices, and at that point the talking point was about production cuts by the OPEC and how this will move the prices higher. Do these events accelerate that price up move? What are the near-term targets that you would keep in mind?
Look, at this stage, we've kept our WTI price at $65 for year end and our Brent price at $67. So with the Brent price, we're not far away. Primarily what we're looking at in terms of what will influence those prices going into the end of the year is certainly, yes, the OPEC and its allies keeping to the 32.5 million barrel ceiling, and perhaps at the upcoming 30 November OPEC meeting, extending the time out beyond the 31st of March. There's certainly key aspects that we will be looking for support in the oil price market. The other is we're watching very closely still what's happening with, firstly, US inventories, and they continue at this point in time to decline, and also what's happening with US domestic production. And unfortunately, we've seen US domestic production just continuing to rise gradually over the course of the last couple of months. So we see a whole mix of pressures on the oil price. But at this stage, on balance, we'd suggest we'd be very happy to keep our end-of-year price at around 65 for WTI and 67 for Brent.
The underlying trend, David, has been relatively bullish over the last several months now for oil. What is OPEC's thinking on this? Are we looking at a price of about $70? Is that what the OPEC is positioning for?
No, look, we think at this stage OPEC's not looking for an actual price to set. Otherwise, they could just go in and actually cut production, and that would significantly improve the price. We think all they want to do, and they've said this over many occasions, is they just want to stabilise the market and get the oil price away from those lows that we did see late in 2016, early this year. So with that in mind, OPEC has probably done a fairly successful job in terms of first complying. That's been a problem that organisation's had. Now that the market's comfortable with the compliance aspect of the OPEC ceiling, we will be now looking for them to perhaps go further ahead and increase the time that we will see for the expiry of the current agreement.
All right, David, appreciate you joining us to give us a sense on the oil markets. As always, great to hear your thoughts. That's David Lennox speaking on the upside on oil. Let's step into a quick break. We'll come back, talk about, well, it's been 1 year since demonetization, take stock of the economy. What did it do to economic growth, if anything? Sajid Chinoy of JP Morgan with that conversation.
Watch us live in conversation with Ramdev Agrawal as we talk about the power of price.
Market is very, very competitive, and now there is a FI market, there is a DI market, and the bucket is same. What is the right price? I mean, at what price you should buy, and how do you tackle this overvaluation, the problem of overvaluation right now? Should you avoid buying?
Watch us live in conversation with Ramdev Agrawal on the 7th of November at 11 a.m. as we talk about the power of price in the process of investing. Send in your queries using the hashtag AskBQ to BloombergQuint.com. Write to us now. Use the word Ramdev in all your queries.
The 500 rupee and 1000 rupee currency note will no longer be legal tender from midnight onwards.
On the 8th of November 2016, the Government of India announced that 500 and 1000 rupee notes would be invalidated. Overnight, 86% of the currency in circulation was cancelled. The goal? To deal a financial blow to the black economy. A year later, was it all worth it? Watch the demonetization experiment on the 8th of November with Ira Duggal, only on Bloomberg Quint.
Back on Power Lunch, the headlines at this hour. Indian markets trade flat. Oil marketing companies are the top losers as oil prices head higher.
On the first leg of his Asia trip, President Trump presses Japan for bilateral trade deals, suggests negotiations to close the wide trade gap have gone on for far too long.
700 Indians figure on the list of Paradise Papers, the latest data leak dealing with offshore funds and tax havens. All right, quick check on how the markets are faring at this point in time. It's been a quiet sort of flat day, but what are the stocks that you're looking at, Pradeep?
So look at the Nifty first of all. Over last half an hour, Nifty has in fact hit a new high. So that's really interesting. Since morning, although indices were flat, if you're looking at Nifty and Sensex or even mid-cap and small-cap index for that matter. But when I checked, even an hour back, you could clearly sense that 90% of the stocks moving with good volume were actually on the buying side. So traders have been on the long side, and now I think they're getting rewarded. If you look at advanced decline ratio, that's also turning better as of now. Two sectors that have been leading. Real estate and auto. These have been two strong sectors since morning. But look at the heavyweights. ONGC, while oil marketing companies are definitely getting hurt because of the rising oil prices, although these days, since they managed to really pass on everything on a daily basis, I think this is also a sentimental reaction, so to say. But ONGC has definitely gained. Also on the positive side are PSU banks. Look at some of the mid-cap PSU banks, Indian Bank, Union Bank. In numbers, people are really looking at the slippages and gross NPA and just reacting to that, which has been very positive. Titan also came out with a good number. And look at the reaction, not only at Titan, but PC Jewelers, TBZ. And in fact, these numbers have in fact kind of electrified the entire sector, one can say. PSU companies also continue to move up. Hindustan Copper, Dredging Corporation, State Trading Corporation, they are all moving up today. So all in all, we can say it has been a good day of trade so far. Disappointments, if any, very few, maybe some ADAG stocks like Arcom because the deal didn't really go through, or the Reliance Capital. Interestingly, even after the listing of Reliance Nippon Life at a premium, this one has really been sluggish today. So there are a few exceptions actually only on the negative side.
Thanks so much for that, Pradeep. That's the structure of the markets here halfway through the show. Let's get a check-in on the global markets as well. Jan Lamberts, Director, Head of Research Asia at Rabobank International, joining us on the phone line. Jan, thanks so much for joining us. Appreciate you taking the call at short notice. I guess, the first question I want to check is are the markets taking note of what's going on in terms of the Paradise Papers? There's some very prominent names in there, both globally and also, of course, for India. But are the markets paying any attention to that story?
There isn't any impact. It should be quite short-lived. We know that from the Panama Papers a few years back that the actual market impact was very, very limited. I think people pay attention because of the high sort of gossip value there, and people are a bit amazed by the names they're seeing in there. But I don't think that's going to drive the market so easily this week. It's more about U.S. tax reforms coming through. Trump, of course, visiting Asia. The crackdown now in Saudi, for example, it's playing through. A couple of central bank speakers, but not a whole lot of data this week.
And specifically about Saudi Arabia, how do you think the markets are reading the developments that are going on? One is a geopolitical tension. The other is what's seen as a purge by the crown prince of corruption. Is the market taking note of it? Is it nervous?
I think we're definitely seeing the market take note in terms of oil prices being under upwards pressure. It's exactly what you're saying. It's two-pronged here. On the one hand, there's the proxy fight with Iran, which is just the next step. On the other hand, it is a purge taking place. A lot of people feeling that anti-corruption is a rather vague charge. It seems to be mostly vocal opposition to the current crown prince that's being taken out. People are watching this. Could be an interesting situation for Mr. Trump as well, who's, of course, closely aligned to the king and the crown prince.
We're also talking at a time, Jan, when the S&P's had the 8th weekly advance, which is perhaps the best since the last 4 or 5 years. Where do you think we're positioned? Where do you think global markets are positioned at this point in time as we head to the end of the year? Do you believe there is more upside left? What does this mean for risk sentiment?
Yeah, I can't rule out further upside. And the very reason is that despite all the talk by central banks, there's still an awful lot of stimulus out there. if you look at sort of what central banks are still pushing into the economy every month, you look at the expansion of their balance sheet, it's still ongoing, and that supports a lot of these equity markets together with some decent earnings reports. The more near-term stimulus, though, you can look forward to is U.S. tax reforms or at least some stimulus there. It looks like there's a good likelihood the House will get something through. The Senate are in the U.S. presenting their own version. If they can get together on that before sort of the year end, then the Republicans will get their one legislative achievement of this year, which they very much need, and the markets would take that as a big positive because it'd be quite favorable for a lot of these companies.
Very quickly, and what about the dollar? Do you expect dollar strength to continue?
Yeah, I think it's well priced at the moment there to strengthen further. Like I said, they continue to warn themselves as well to the tax reforms. For that, though, to be sort of a thing you see develop over the next couple of months, those tax reforms have to be successful.
Yeah, and thanks so much. Appreciate you taking the time to speak to us on the global market picture. Let's bring the conversation back home. We are almost onto the one-year anniversary of demonetization. 8th of November last year was a hectic, chaotic day with the government announcing that 500,000 rupee notes will no longer be valid. What followed now is for the history books. What we are still trying to understand, though, is what was the impact this had on the economy. That debate is still out there, and questions are still being asked whether there was an implication for supply chain, and whether some of the downtick in GDP growth that we saw in the fourth quarter of last fiscal and the first quarter of this fiscal was related to demonetization. Joining us to talk through some of the economic impact or try and understand the economic impact is Sajid Chinoy, Chief India Economist at JP Morgan. Sajid, thanks so much for joining us. Appreciate you taking the time. Do you actually now, having had the benefit of hindsight, think that the economy did get hurt because of demonetization? What did it look like before we went into demonetization? And were the last couple of quarters of weakness linked to demonetization?
You know, in our view, growth began to slow much before demonetization. If you look at the numbers closely, GDP growth between April of 2016 and September of 2016, before demonetization, slowed by almost 200 basis points. And there are very good reasons why that should have happened. Number one, we've long maintained that the collapse in oil prices gave India a very large positive terms of trade shock that boosted growth. And therefore, in the year 2015-16, growth accelerated to 8%, despite it being a drought year, because a lot of this was underpinned by the falling oil prices and the positive terms of trade shock to households, to the government, to firms. That was always a one-time transitory effect. So as soon as oil prices stabilized, those growth benefits would begin to roll off, and we saw that happen early 2016, explaining some of the slowdown. The second reason was it was exactly in that period of time that policymakers correctly doubled down on deleveraging, on the asset recognition process, and that also contributed to the slowdown. So it's important to understand the macroeconomic context here. Growth was already slowing in the quarters before demonetization, both because the oil windfall had begun to roll off, and we were getting very serious about bad asset recognition and the deleveraging process.
Let's try and look at the counterfactual, Sajid. Is there any way of assessing where the economy may have been if demonetization had not happened?
You know, it's very hard to always analyze what the counterfactual may have been, what the economy would have been absent demonetization. But a couple of things I think are quite clear. One is there was a transitory near-term growth hit for a couple of quarters. So absent demonetization, GDP growth would have been a little bit higher. The second was, in our view, we've had a temporary adverse supply shock. And what I mean by that is supply chains involving small, medium enterprises in the informal sector have been disrupted, and that activity has been replaced by much stronger imports, manufacturing imports. And that's the only way to rationalize why, even as domestic demand has been slowing the last 3 or 4 quarters, imports have been accelerating. So, you can reconcile those things when you recognize that this could have been an adverse supply shock. But remember, these near-term disruptions need to be traded off with the medium-term benefits. Already you've seen that there's been a big raft of financial savings post-demonetization. To be sure, this had started even before, but has been accelerated since. cash holdings in the economy are less, and you can glean that by looking at the interbank liquidity surplus, which is still very sizable. And third, you've begun to broaden the tax base. The number of first-time or new tax filings this year is almost 27% higher than last year, and that's much more than the growth rate in previous years. So there are near-term costs that need to be traded off with more medium-term benefits.
Sajid, in particular, there have been questions raised about the disruption to supply chains, first because of demonetization and then perhaps because GST followed so quickly after that. You have pointed out some data points, in particular on the import side, which suggest that there may be some supply disruption.
I think the best way to appreciate that this could be a temporary adverse supply shock is to look at the data. In the last quarter, where GDP growth slowed from 6.1% to 5.7%, the current account deficit quadrupled from 0.6% of GDP to 2.4% of GDP. Now, the widening of the current account deficit was not because of, largely because of weaker exports or oil imports or gold imports. 70% of the widening was because very strong, broad-based increase in manufacturing imports. So the puzzle is, in the last 6 or 7 months, imports have been growing at 15% a year when growth is slowing, compared to the fact that for the previous 2 years, imports were contracting at 5% a year. So how does one reconcile the fact that at a time where domestic demand is slowing, manufacturing imports are increasing, and they're very broad-based in nature across multiple sectors? Our rationale is that this is, demonetization and GST have likely disrupted supply chains that involves the informal sector, small and medium enterprises. I mean, ultimately, the whole goal of these reforms is to push the economy to become more formal. So the near-term cost is some of these informal firms have likely been affected, and as a consequence, larger firms that used to rely on these SMEs have had to import what they were previously purchasing at home, and that's how you explain weaker growth and this broad-based acceleration in imports over the last 8 or 9 months.
On the positive side, Sajid, there are two things being pointed out. One, that digital transactions have increased, and second, that more money has gone into financial assets. The second one in particular would be beneficial for the economy for sure. But is that a tenuous link, or are you convinced that there is a link between demonetization and that change in trend?
I think it's undoubtedly the case that financial savings have increased even before demonetization for a number of reasons. I think the attractiveness of both real estate and gold has become less, and real rates have become positive, and therefore that's moved some savings away from physical assets to financial savings. But if you look at the data, it's undoubtedly the case that this process has sharply accelerated after demonetization. And I think the best way to understand this is you've had a lot of money come into the banking system, and yet a lot of that has remained in the formal network because currency in circulation is still now 20% less than it should have been pre-demonetization. And ultimately, these formal financial savings have to find their way somewhere, and in a way that explains why you've seen assets under management for mutual funds, for example, or life insurance subscriptions, for example, pick up quite dramatically after demonetization. So both things are true. There was a rising trend even before demonetization as SIPs became more broad-based and more fashionable, and that trend has accelerated sharply after demonetization.
All right, that's Sajid Chinoy speaking to us about the economy. Sajid, thanks so much for that.
All right, President Donald Trump kicked off a 12-day Asian trip and presses for Japan for a bilateral trade deal, suggesting that negotiations have drawn for longer than he would have liked. Bloomberg's Stephen Engel, who's currently in Tokyo, reports on all that has transpired during his visit.
He's talking on both sides. He's saying on the one hand, of course, Japan is a great strategic partner in this part of the world. But on the other hand, we have a big trade deficit, $69 billion in 2016, the second largest nation with a deficit, of course, second only to China, which is about 4 or 5 times larger. But he wants he's being Trump the negotiator as he sits across the table with his Japanese counterparts at the bilateral table right now as they try to get a framework for perhaps a bilateral trade agreement in lieu, of course, of the TPP that Donald Trump has pulled out of. We'll be getting more, of course, his insights onto the bilateral front versus the multilateral front when he goes to like APEC and ASEAN later this week and into early next week. But basically, Donald Trump saying right now trade with Japan is not fair. It is not open. But he also says no doubt that he can be negotiated quickly and fairly friendly manner. So, again, two sides to Donald Trump, the negotiator. This is what he had to say about his counterpart, Shinzo Abe.
The relationship is really extraordinary. We like each other, and our countries like each other, and I don't think we've ever been closer to Japan than we are right now.
So it has been a busy day for Donald Trump. Of course, he met with the emperor. He also had meetings with the U.S. and Japanese business leaders that included the top executives from the likes of Mitsubishi UFJ, Bridgestone, Honda, Mazda, Nissan, Mitsubishi Heavy, Suntory, Denso, SoftBank. Masayoshi Son was there in this morning breakfast talk. Also on the U.S. side, Boeing, Eli Lilly, Intel, Johnson & Johnson, Lockheed Martin, many others. So it was a very busy morning that's going to conclude with a joint press conference coming up within this hour.
Stephen Engel reporting from Tokyo. Expect the cheap oil trade to reverse soon. That's the word coming in from Shyam Shekhar of iThought. Earlier today, in a chat with Bloomberg Quint, he further says that rising global interest rates and oil prices have the ability to create instability in the markets. Here's a slice of that conversation.
Cheap oil trade has got overdone. That is one thing that I have noticed across industries. I think the cheap oil trade has been converted into some kind of a long-term trend by the market. I think this is a very costly mistake for which prices will be paid in the future. Cheap oil led to a lot of commodities and generic businesses seeing their profits expand. But I think the companies are going to come back with a vengeance and do capex. So I think the market's over-enthusiasm in these businesses, typically chemicals, plastics, many areas where we have bought companies where the earnings expanded simply because of cheap raw material inventory. So you're basically giving an inventory profit a multiple. I think that trade is overdone, and I expect that trade to reverse very swiftly in the coming 2 quarters. So that is something which I'm quite surprised that the market is making as a mistake. And I think that that mistake will prove costly. Well, the sad thing is that retail is very heavy in this. I don't think the institutions are so much involved as retail.
But there is also a generalized impact that cheap oil has had on India's macro, on the expectations with regard to the bond yield and interest rates in general. If that starts to reverse, the way big analysts are actually revising their price target on crude oil up, what happens to the kind of valuations, the PE that our markets are really commanding at this point of time?
See, I think there are 2 types of trends that we can see in India. One is what will happen because of macroeconomic reform, which the government is steadily pursuing, though it is not at the pace at which we would like it. So I think the benefits of that will play out on one side. I think where they are replacing imports with domestic production in many industries, I think also the bank restructuring, I think that is one thing that will stabilize the market in 2018. What will destabilize the market is rising global interest rates and rising oil prices. I think these 2 are risks to the market, and these can definitely impact the market because we have already given multiples to many industries without understanding or without factoring in the impact of oil prices rising.
What has been your thought on what happens to the NBFC pocket? Because the street is divided down the middle, valuations sky high. Then the PSU Bank recap came and people thought that maybe there'll be money moving out of NBFCs into PSU banks. I don't really want to talk about PSU banks right now, but more so NBFCs. One, do you think people will continue to favor them? What would you be doing yourself? And can these valuations sustain?
Yeah, finance company should always look at its customer's balance sheet. So if you look at what went wrong with corporate banks between 2010 and 2015, it is the misjudgment of the balance sheet of the customer. I think the NBFCs are likely to commit or to have committed the same mistake in the last few years. I think that they have not properly assessed how the balance sheet of the retail investor or the retail borrower is going to change. And I think the impact of this is likely to be felt. Another thing is that I think the quality customer base, that is the base of creditworthy customers, is not going to expand at the same rate at which the industry wants to grow. That is this private finance, that is NBFCs and HFCs and all these guys. The rate at which they want to grow will be far higher than the rate at which the creditworthy customer base is going to grow. And I think this match is going to play out over the next 3 to 4 years. And we already see the larger players, be it HDFC or HDFC Bank or even other banks, trying to come into this space and build their business with retail clients. So I think that retail is going to get overcrowded, and NBFCs don't really have the kind of superior skills to acquire creditworthy customers. I think that that is something that is going to be a challenge.
If I look at the earnings trend this quarter, the belief was that would the input cost pressures be outweighed by this eventual product price appreciation that some of these companies could see. And we've seen that there's a clear divide out there. That's not been the case this earnings season at least. What would you do with some of the commodity-based names?
See, I think that specific to steel, I think the most important event that market should wait for and analyze properly is how these capacities that are being settled through the NCLT are acquired. I think whether the existing promoters manage to retain or new people retain. I think it's extremely important for both JSW and TISCO to mark their presence in this area.
All right, it's one of the biggest data leaks in history, documenting various tax evasion activities by companies and individuals. We're talking about the Paradise Papers, which we discussed earlier in the show as well. But just to give you a summary of what all has been reported, Alexander Matthew is standing by. Alex, just summarize the reports for us. There's a lot in them.
Absolutely, Ira, and right up front, this is not essentially, we've not seen the data. We're reporting, or this is a compilation of what's been reported so far. But what are we talking about? As much as 13.4 million files amounting to 1.4 terabytes of data. That's been acquired by German newspaper Süddeutsche Zeitung, and they enrolled the help of the International Consortium of Investigative Journalists to essentially sift through that data. Incidentally, this is the same newspaper that also got the data dump for the Panama Papers. But what does it relate to? It essentially relates to the hidden wealth of individuals and also the fact that corporations, hedge funds, and others could have skirted taxes over a period of time. Now, here are the key highlights of what's been reported so far. The Guardian has reported that most of the leaked documents relate to Appleby, which is a law firm, offshore law firm. It has outposts in several tax havens. For its part, Appleby has said that there is no evidence of wrongdoing by itself or by any of its clients. But what are the big names that have been talked about so far? The Guardian has reported that millions of pounds from the Queen's private estate, the Duchy of Lancaster, has been invested in the Cayman Islands through a fund. It also relates to Russian institutions which have close ties to President Putin that have funded large investments in the social media giants, that's Facebook and Twitter. But it gets a little murkier there. Those investments were made through Yuri Milner, who is a business associate of Jared Kushner. Kushner, as you know, is US President Donald Trump's son-in-law and also a senior advisor to the White House. As many as 714 Indians have found mention as well, and that's essentially according to the Indian Express, who've been carrying out the Indian leg of investigations. The Sun Group figures prominently as Appleby's second largest client globally, with 118 different offshore entities. Now, the other prominent Indian corporates, and I'm going to read them off: Jindal Steel, Apollo Tyres, Havells, the Hindujas, Videocon, and the Anil Ambani-group have found mention. The paper also reports that a Minister of State for Aviation, Jayant Sinha, did not disclose that he was a director of a US company that's D-Light Design. Sinha reported or rather responded to the report saying that he had worked with Omidyar Network as a managing director, and Omidyar Network had invested in D-Light. But that's broad brush what we have so far.
Alex, we'll leave it there. Thank you so much indeed for joining us. Out of time on the show. Thank you so much for joining us today.